Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Shares of Ford are down almost 30% in the past year. If you're watching this video, there's a good chance you're looking at Ford and thinking that it's a bargain stock to buy. That may prove to be true, but before you race to hit the buy button in your brokerage on Ford shares, we think that there might be a much better bargain place to buy in Legacy Auto right now. I'm Jason Hall. This is The Smattering. I got Tyler Crow here with me. Tyler is the one that brought this idea to me, and I think there might be something there. Hey, Tyler.
How's it going, Jason? You and I have a complicated history with Legacy Automotive, just automotive in general. And
No, I think
so
it's incredibly uncomplicated because the reality is
we don't
that
like
by
it.
and large, we think it's a terrible place to invest because history has shown us it is not a great place to invest, particularly over the long term. There just haven't been any great long-term winners that have helped people create wealth. But Tyler, and I think this is the point you're going to make here, sometimes the market gives you opportunities in this highly leveraged cyclical space that's tied to consumer demand that you can buy on value, deeply discounted companies, and generate really solid returns.
Yeah, and that's where I think we can go with this one here. And not to keep burying the lead any further, the company we want to talk about here is Stellantis. Now, if that name doesn't necessarily sound familiar, it's because it's a relatively new thing. That was the merger of Fiat Chrysler and PSA Group, which is Peugeot Citroën, the French automakers, and combined, I guess you could say, almost house of brands of automotive. So Dodge pickups, Jeeps, Fiat, like I said, Peugeot, Citroën. There's at least another half dozen other brands that kind of sit under the Stellantis blanket, and it looks incredibly intriguing because it really seems like the market is discounting this one much more than even what we would consider cheap legacy automotive.
Yeah, I think maybe the market to a certain extent may have caught on to the fact that there is something here over the past 3 years or so. From the high price over the past 3 years, Ford stock is down around half. But then you take a look at Stellantis stock, it's been on a pretty good run from the beginning of the year, but it's still down substantially. It still trades for what you think is really dirt cheap.
Right now, it trades for a forward estimate of 3.3 times earnings, and on a trailing price to earnings, it's 2.9 times earnings. So that is cheap, even when we're talking about autos here. And this is where it gets even more interesting to me, is that even though it's trading relatively cheap, even by auto standards, its balance sheet is even more cheap, because if I'm looking at this company right now, it's about a $51 billion company by market cap. Now, if I look at its balance sheet, it has $52 billion in cash and $25 billion in debt. So you can say 26, 27 billion net cash. But if I'm to discount the market cap for just kind of cash sitting there, you more or less have a 25, $26 billion enterprise value, if you will, market cap minus cash.
That's remarkably cheap for one of the largest automakers on the
It is,
planet.
it's the third. It's behind Toyota and Volkswagen as the third
Volkswagen.
largest. So on a sales basis, larger than Ford, larger than GM. And they're moving into EVs, and there should be a premium on EVs. Stellantis does have that. 2024, I believe, is the year that the Ram pickup truck is going to launch its own EV version. The Fiat brand has been launching a lot of commercial vans using an electric vehicle platform in Europe. And they're seeing a little bit more of an aggressive push into electric vehicles on its European fleet versus its US offerings, because Jeep, Ram pickup, they haven't exactly been the brands that you would expect to be at the spearhead of electrification. It clearly has a plan in place. It is extraordinarily cheap. Its returns on capital has actually been quite astounding. A 13% return on capital in the past couple of years, with this huge cash position and clearly a path forward into electrification. Maybe not the most exciting, but you lump all that together and say, why does this company merit being valued at basically half of the other legacy automakers?
That's the key. You're not looking at Stellantis necessarily as the most popular or the best, but you look at that collection of brands, you think about how management has consolidated these disparate parts together. to create a strong, high return operation, it really feels like the market is deeply discounting it and creating an opportunity for investors. I think if you're looking to own it for multiple years, Tyler, I think you're right.